The statement lands. The closing balance looks ugly. The minimum due does not. You tap it, the account stays current, and a slice of paychecks you have not earned yet is already booked. In this video, we'll use the 2-year figure on the front of the statement and freeze a higher fixed debit so the claim on the next payday cannot quietly shrink. We saw this on our own statements, direct debit set to minimum due and the debit shrank. Moneysmart and the Reserve Bank are why we stopped treating current as paid off. The fix is already printed on the statement's front page. This is general information, not personal advice, so your own rate and floor still deserve a professional, and before we get there, wait until you see how long a $5,000 balance can last on declining minimums. The number sounds made up. The private question is the awkward one. If we are never late, how can the fortnight still feel booked? That worry is allowed. Being current is not the same as being finished. Checkout already happened. The goods are in the house. The only decision left on the statement is how much of this month's pay to send the bank. The minimum is designed to be payable. That is the point of it. A small monthly floor is still useful flexibility for one rough month. It is a poor plan for the years after that. The leak is the lifestyle. I'll clear it when things calm down. We ran a household model, not your card. A $5,000 revolving balance, no new spend. On a declining minimum, the interest pile was the part that stopped us. On that same model, the declining minimum took about 44 years to clear. The account never screamed. The leftover for groceries did. Here is the cleaner way to see it. The decision is not, are credit cards evil? Paying the closing balance in full is still the cheapest way to use one. The question is whether this month's minimum is already queued for the next 6 paydays. Moneysmart describes the usual formula in plain language. A percentage of the closing balance, typically 2% or a little more, or a small dollar floor, whichever is greater. Because the percentage applies to a shrinking number, the due amount falls even when you have barely touched the principal. The floor is usually around $20, and the minimum is never more than the closing balance. That sounds protective. It is also how the claim on the next paycheck gets quieter without getting shorter in years. What surprised us was not a single minimum. It was the second, third, and fourth. Direct debit was set to minimum due. As the balance inched down, so did the debit. Automation is useful. Automating a shrinking floor is how a past purchase keeps a standing reservation on future pay. This one caught us out too. It felt responsible. The first year is the part that hijacks the fortnight. Most of what you send can sit on the interest line. Principal barely budges. After 12 payments, the balance is still almost the same ugly number. A $100 minimum does not sound like a crisis on its own, until you remember it is already sitting in front of rent, the grocery run, and the rest of the fortnight. It is wearing a paid-on-time badge. Once you can see the booking, the next move is not never use a card. There are 4 ways this usually feels, and they are not all panic. The first option is still the cheapest. Pay the closing balance in full by the due date. Interest-free days only survive if you do. The vibe is boring, and boring is the goal. The hurdle is this fortnight. If the closing balance and rent cannot both leave, paying in full is not available tonight. That does not make you reckless. It means the next option has to be a freeze, not a shrug. The second option is Moneysmart's practical tip. Keep paying the same dollar amount as the balance falls. Freeze the first minimum so the debit cannot shrink. On our model, that cut years off the story. Freezing the first minimum on that worksheet still took about 9 years, better than a lifetime, not a magic wand. The catch is you must actually leave the dollar amount alone when the statement offers a smaller due. The third option is the number on the front of the statement, the monthly amount that would clear this closing balance in 2 years with no new spend. That is the line most households should argue with, not the minimum. In our illustration, that figure was $254 every month. Do not copy it onto a card you have not opened. Use the warning on this statement, then the Moneysmart calculator with this rate. The fourth option is hardship on purpose before the due date. A minimum exists so one bad month does not become a default. Using it as the plan is how future income arrives already spent. Using the minimum once after a car repair or a gap between contracts is the product working. Leaving the direct debit on minimum after the shock has passed is the trap. This may matter differently if income jumps around. A variable month is exactly when the minimum exists as a shock absorber. The next check is a date to switch the debit back to a freeze. Another trap that looks responsible. paying the card with another card or with buy now pay later to keep it current. If the fortnight only works because a new balance is opening, that is not cash flow smoothing. Points do not offset a purchase rate over 18%. A rewards card that is never paid in full is a more expensive version of the no-frills card you refused. Comfort purchases plus interest quietly reprice the fortnight. Overseas research named the pattern. Debt is persistent when interest and fees make up at least half of actual payments over a year. Our illustration would fail that test in year 1. Different country, same mechanism. So pause on this privately. Is this month's minimum a one-off shock absorber or a booking already sitting on paychecks you have not earned yet? You do not need to answer out loud. You need the warning box on the same page as rent. The Reserve Bank's April 2026 retail payments release put $21.4 billion of card balances in the accruing interest pile. That is the revolving book, already a claim on future income. It is not your statement. It is why the lifestyle exists at national scale. There were millions of cards on issue. Moneysmart's payoff page still quotes older round numbers. Use the bank's latest table when the two disagree. Your household is not a national average. The mechanism still travels. Moneysmart is blunt about the rate. The average credit card interest rate is over 18%. Carry a balance, and last month's points card is just an expensive loan wearing a nicer jacket. Australian statements are supposed to say this out loud. A credit law regulation requires a minimum repayment warning on the front page, with limited exceptions, a tiny balance, or a payment arrangement that replaces the normal minimum. The prescribed wording is the opposite of marketing. If you make only the minimum each month, you will pay more interest and it will take longer to pay off the balance. No jazz hands, just the comparison. Where payoff on the minimum would take more than 2 years, the box also shows the monthly amount that would clear the closing balance in 2 years and the interest you would save. No new purchases, rates and fees held still. It is a comparison, not a promise. A local issuer has already shown how ugly that box can look, decades and a pile of interest versus a 2-year alternative that is sharply smaller. That is one product's illustration, not a forecast for every Australian card. On our worksheet, declining minimums were the long road. The 2-year figure was the argument. Issuers do not all use the same minimum formula. Use this statement, then the calculator with this rate. A year of minimums is not only cash flow. Late or missed payments can be reported. Lenders may see revolving balances when you next want a car loan or a home loan. Paying on time is not the same as a default, and it is not invisible either. If a home loan is on the horizon, pull your free credit report. Do not assume a long-running card balance is invisible. Moneysmart's credit score guide is the place to start that check. Rolling several cards into a personal loan can look like a cleaner debit. Sometimes it is. Sometimes it is a longer, still expensive claim on the same paycheck. Compare that path before you refinance shopping into a new term. The cousin trap on a mortgage is the opposite shape. When the required repayment falls, the extra can quietly stop. On a credit card, the falling minimum is not a gift. It is how a mid-size balance is still there in a decade. If the warning box already shows decades, that is not a verdict that you failed. The smallest useful action is not a new spreadsheet. It is switching the debit to a fixed amount you can actually fund after rent and food. We would do this differently next time. One statement, one frozen dollar amount, one debit date the day after pay lands, as Moneysmart suggests. You do not need a new personality. You need a floor that cannot shrink. Open the front page, write down the closing balance, the minimum due, the due date, and the 2-year figure. If the box is missing, the balance may be tiny or you are already on a hardship arrangement. Circle the next 2 paydays. Put the card debit on the calendar next to rent. If they collide, the card is not extra. It belongs in the same line as the bills that keep the household standing. Change the direct debit from minimum to a fixed amount. Floor this month's minimum so the debit cannot shrink. Better the 2-year figure if rent and food still clear. Stop feeding the balance. Put the card in a drawer or ask the issuer to cut the limit. The limit you are offered is assessed against an ability to repay within 3 years. You do not have to take the full offer. New applications also hit the credit file. If the plan is to freeze and clear, opening another product to keep it current usually books more future pay, not less. If this month's minimum will bounce, contact the issuer's hardship team before the due date. Moneysmart says lenders must consider a hardship request. Complaints go to the issuer first, then the free external scheme if that process fails. If more than one card is in the stack, the National Debt Helpline is 1877 on weekdays. That is a 1-hour job. The next checkout can wait. Ignore minimum due as a budget. Ask, after rent and food, what fixed amount can leave on the same day every cycle until the 2-year box is boring. If you cannot name it quickly, do not add another purchase to the card. Treat a sale price as irrelevant if the reservation number fails. Take the page to the next conversation with a partner or with the issuer and ask whether the freeze, the limit, or hardship is the line that actually moves. You do not need to solve the whole decade tonight. You only need a floor that cannot shrink sitting after rent and food. Once you can see the booking, you are no longer guessing, you are choosing. The honest counterpoint: a minimum exists so one bad month does not become a default. Using it once on purpose is the product working. Using it as the plan is how future income arrives already spent. You have a clearer next step now, a floor that cannot shrink, not a screenshot of paid on time. Subscribe, we put out one of these guides every week.